If you are over 60 and still investing like you are 40, I want to tell you something you may not enjoy hearing. You are not being optimistic. You are being careless with capital that cannot be rebuilt the same way again. That is the truth. And truth matters more than comfort when you are this close to the part of life where money stops being a scorecard and becomes oxygen. When I was younger, I could afford mistakes. A bad year in the market was unpleasant, but it was not fatal to the plan. Time could repair a lot. New savings could repair even more. A speculative idea that failed was not a life sentence. It was tuition, that is youth. Youth has one giant hidden asset: recovery time. By the time you are over 60, that asset is smaller, maybe much smaller. That changes everything. The problem is that many people do not change with it. They keep the same instincts. They chase the same excitement. They listen to the same voices. They let the same hot ideas into portfolios that are now supposed to pay bills, preserve dignity, and carry them through a period of life where capital losses are no longer just numbers on a screen. They are lifestyle damage. That is the part most people refuse to look at until the market forces them to. I would rather you look now, because if you want the mother line for this whole story, here it is. After 60, the first job of money is not to get rich fast. It is to stay useful, stay real, and stay alive long enough to fund a life without forcing desperate decisions. That is the line. Read it again. Because once you really understand it, your whole definition of safety changes. Most people still think safety means low volatility, a big brand name, a high yield, or a familiar ticker. Number safety at this stage means something much harder and much more serious. It means capital preservation, predictable income, protection against inflation, protection against your own bad timing, protection against being forced to sell the wrong thing at the wrong moment. That is what safety means now. And if your portfolio is not built around those realities, then it is not safe just because somebody in a suit once told you it was diversified. A diversified mistake is still a mistake. A diversified delusion is still a delusion. The market does not care that your advisor called it balanced if the structure collapses exactly when you need it not to. That is why I want to talk about 3 types of investments that are genuinely useful for people over 60. And I want to do it without romance and without the usual retirement sugarcoating. Because retirement investing is not about fantasy. It is about survival with dignity. And dignity has a price. Now let me start with the first mechanism. I call it the time compression rule. The time compression rule is what happens when the number of years you have left to earn, save, and repair large mistakes starts shrinking much faster than your investing habits do. Definition is simple. The older you get, the more expensive a bad decade becomes. That is not pessimism. That is arithmetic. If you are 35 and your portfolio gets cut in half, that is painful. If you are 68 and your portfolio gets cut in half while you are withdrawing from it to live, that is an entirely different kind of event. It is not the same percentage loss. It is a different life problem. This is what younger investors routinely fail to understand when they give advice to retirees. They think every drawdown is temporary because their whole mental model assumes future earning power and future contributions. A retiree does not always have that luxury. He may be selling into the damage. He may be drawing income from the exact assets that are under stress. He may not have another 10 or 15 prime earning years to rebuild. That is why I say after 60, you do not invest like a spectator. You invest like a steward. The time compression rule turns a reckless portfolio from a growth experiment into a potential lifestyle threat. If you lose 30% at 35, you may call it a lesson. If you lose 30% at 70 and need distributions from the account, you may call it a forced move to a smaller house. Fewer choices, less travel, more fear, and more dependence. That is a different animal. It is why I have no patience for retirement advice. That still sounds like the person giving it assumes you are in the accumulation stage of life. You are not, you are in the preservation and distribution stage that changes the rules. Anyone who talks to you as though it does not is not serious. Now, let us move to the second mechanism. I call it the sequence knife. This is one of the most dangerous things in all of retirement finance and one of the least emotionally understood. The sequence knife is what happens when bad market returns hit early in retirement while you are simultaneously withdrawing money. This is how portfolios bleed to death quietly. Not because the long-term average return was terrible, because the bad years arrived at the wrong time. That is sequence risk. A market decline in year 1 or year 2 of retirement is not the same as the identical decline in year 20, because early losses shrink the base from which all future recovery must happen while you are still taking money out to live. Imagine two retirees with the same average return over 10 years. One gets the bad years first, the other gets them last. The first retiree can be in far worse shape even though the average looks identical on paper. That is the knife. It cuts through the lazy belief that long-term averages alone protect you. They do not. Sequence matters, timing matters, withdrawal timing matters, most of all. This is why I get impatient when people wave around long. Run stock market returns as though retirees can simply ignore order and live on the arithmetic mean. That is not how real life works. Real life has bills, real life has health care, real life has roofs, taxes, utilities, grandchildren, travel, and emergencies. If you are withdrawing from a portfolio in a brutal down cycle, you are not just waiting for a recovery, you are harvesting damage. That is why after 60, you need assets in the portfolio that are there not to impress you in good times, but to protect you from making forced sales in bad ones. That is what safe investments are really doing. They are buying time. They are buying emotional stability. They are buying the right to avoid turning temporary market stress into permanent financial damage. That is why I do not want an all-equity retirement portfolio, no matter how many younger geniuses tell you the market always comes back. Yes, over time it often does. The problem is that you may not be able to wait in the same way anymore if the sequence is wrong. That is the whole point. Now let us move to the third mechanism. I call it the inflation leak. This one is brutal because it is quiet. The inflation leak is what happens when a retiree believes nominal stability is enough, while the purchasing power of the portfolio is being steadily drained year after year. This is the silent killer of retirement money. People obsess over stock market crashes because crashes are visible. Inflation is usually more polite than that. It does not scream, it erodes. It takes one small bite after another, 3% here, 4% there. A jump in healthcare costs, higher food prices, higher insurance, higher taxes, higher utilities, and because the dollars in the account may still look intact, the retiree tells himself he is fine. Then one day he notices something ugly. The account may still exist. The lifestyle it was supposed to fund does not. That is the leak. It is one of the reasons I have always said that cash is not risk. Free cash is stable in nominal terms. It is not stable in purchasing power. If inflation runs at 3% for long enough, your money does not collapse in one cinematic moment. It decays like a roof with a hidden water problem. You do not notice it immediately. Then one day the ceiling caves in. That is why retirees need part of their defense structure tied to inflation itself. Not every part. You need an asset base that moves with the cost of living or at least resists the silent theft better than ordinary fixed promises do. Which brings me to the first of the three truly safe categories: Treasury inflation, protected securities. Tips, boring. Yes, beautiful. Also, yes, if you understand what job they are actually doing. A lot of people dismiss tips because they do not produce dramatic stories. That is exactly why I like them for this purpose. A tips allocation is not there to make you feel smart at a cocktail party. It is there to protect the purchasing power of capital you cannot easily afford to lose. Let me explain the machinery plainly. A normal bond promises a fixed nominal stream. If inflation rises, that fixed stream buys less. A tip structure adjusts principal with inflation, which means the core value grows as the cost of living rises. That is not a perfect shield against every form of pain. Nothing is perfect. But it is one of the cleanest, honest tools available to a retiree who wants capital preservation, plus a real return above inflation when yields permit it. Now ask what that means in practice. If inflation runs at 3%, the principal adjusts upward. If inflation runs hotter, it adjusts more. That matters, because retirement is not 1 year. It can be 25 years, 30 years, even longer. A healthy 65-year-old has a very real chance of living into his 90s. That means your money is not just bridging a few nice years of golf and vacations. It may be financing 3 decades of life. 3 decades of inflation can slaughter a fixed income plan that is not designed to adapt. That is why the inflation leak matters so much. Tips do not fix everything, but they do something very important. They stop pretending nominal safety is enough. That already puts them ahead of much of what passes for conservative advice. Now, let me give you the fourth mechanism. I call it the yield trap. This is where many older investors hurt themselves because they confuse income with safety. The yield trap is what happens when a retiree gets frustrated by low returns on safe assets and reaches for a higher yield without fully respecting the risk embedded inside it. This is one of the oldest mistakes in finance, especially in retirement. The person says, "I need more income," reasonable. Then he sees something paying 6%, 7%, 8% or more. He stops asking the question that matters most. Why is it paying that much? Yield is not generosity. Yield is compensation. The market is paying you extra for something. Credit risk, duration risk, business risk, liquidity risk, complexity risk. Something when people over 60 reach for yield because they are unhappy with what the honest, safe assets are paying. They often end up buying exposure that behaves beautifully, right until the moment they need it not to. Junk bonds, weak preferred structures, fragile REITs, dividend names whose payouts are more theatrical than durable. This is how people get seduced by the appearance of income and walk into capital destruction. I would rather earn 3% honestly than pretend 7% is free and then lose 30% of principal while telling myself I was being prudent. That is not prudence. That is hunger overriding judgment. This is why the second safe category matters so much. High-grade corporate bonds from financially powerful businesses, not junk, not hopeful, not marginal. I am talking about companies with strong balance sheets, stable cash flows, deep market positions, and serious ability to meet obligations through stress. This category matters because it gives you something many retirees need. More yield than treasuries, but without wandering into the swamp. The difference between lending to a fortress and lending to a weak borrower is enormous. Now, even here, I want precision. A corporate bond is not safe just because the company has a famous name. I care about the cash flow, the debt load, the business model, the stability of the underlying demand, the management discipline. That is what matters. A high-grade corporate bond allocation should supplement, not replace. The more defensive core, it exists to improve the income profile without turning the portfolio into a reckless hunt for yield. Now let me sharpen this. A strong corporate issuer that generates reliable cash through products. The world keeps buying is in a different universe from some flashy high-yield instrument paying a seductive coupon because the market is already worried about getting paid back. Those are not cousins. They are strangers. And older investors who lump them together under the label income are making a category error that can cost them years of peace. Now let us move to the fifth mechanism. I call it the duration lie. This mechanism is one of the reasons I do not let people tell me bonds are safe without immediately asking. Which bonds? The duration lie is what happens when a retiree believes the word bond itself confers safety, even if the actual instrument is highly sensitive to rising rates. That is not safe. That is context-free language masquerading as wisdom. A long-dated bond is a giant interest, rate bet. That is what it is. If rates rise meaningfully, the price damage before maturity can be severe. People forget this because for decades rates trended lower and bondholders got used to gains plus income. That era taught lazy lessons. Those lessons are dangerous. Now a retiree who loads up on long duration paper, thinking it is automatically defensive, may find that he owns something that can fall hard exactly when inflation is making the rest of life more expensive. That is not a hedge. That is insult layered on injury, which is why if I am using bonds for safety and income in retirement, I want much more of the exposure in shorter duration or carefully structured inflation protected form and only selective exposure beyond that. Again, the job is not to look sophisticated. The job is to not get trapped. Now let us move to the third safe category, dividend-paying defensive stocks. Notice what I did not say. I did not say stocks are safe. That would be sloppy. Stocks fluctuate. Even the best ones can fall. But a very particular kind of stock can serve a valuable role in a retirement portfolio. Companies with durable demand, conservative business models, stable cash flows, and long histories of paying and increasing dividends, that is what I want. Utilities, consumer staples, certain healthcare companies, businesses that sell things people continue needing through recessions, inflation, and ordinary economic ugliness, toothpaste, detergent, electricity, basic care, medication, food. These do not disappear just because the economy gets moodier. That matters because the retiree does not only need defense against market crashes, he needs defense against stagnation, he needs some income growth, he needs some inflation offset. A carefully selected set of dividend-paying defensive businesses can provide that. The dividend matters because it gives the retiree a cash return without requiring the sale of shares every time money is needed. That matters enormously. Again, not because prices never fall, they do, but if the underlying business keeps paying and if you are not forced to sell, then the volatility becomes more tolerable because the asset is still doing its job. That is a very different experience from owning speculative growth that pays nothing and needs a future market multiple to save you. I have no interest in asking retirees to depend heavily on market enthusiasm. Enthusiasm is a bad pension plan. Cash flow is better. Now let me give you the sixth mechanism. I call it the fragile income illusion. This is where retirees fool themselves into thinking any dividend payer is a safe stock. A dividend is not a halo. A dividend is a claim on future cash generation. If the company is weak, the dividend can be cut. If the balance sheet is strained, the dividend can become a trap. If the business is cyclical and overexposed, the nice-looking yield can be nothing more than the market advertising your upcoming disappointment. That is the fragile income illusion. A safe dividend is not simply a high dividend. It is a dividend backed by stable demand, durable cash flow, conservative payout ratios, and a history that spans more than one easy market. That is why I care about companies with decades-long records of paying and increasing dividends through ugly cycles. That history is not everything, but it is something, a lot of something, because it tells me the business has already been tested in the real world, not only in a PowerPoint deck or a speculative cycle. Now let me turn all of this into one integrated structure. If I were building a retirement portfolio for someone over 60 who needed real safety, I would not start with a performance fantasy. I would start with needs. How much income is required to cover survival expenses? Housing, food, utilities, insurance, healthcare, transportation. Those are the non-negotiables. I want that part of the lifestyle anchored to the safest income, producing core I can build. That means tips, short-duration government exposure, and high-grade corporate bond income arranged in a way that reduces the chance of being forced into bad sales. Then I would ask a second question: how much additional income supports the desired quality of life? Travel, gifts, entertainment, family support, charitable giving, more flexibility. That second layer can be supported in part by carefully chosen dividend, paying defensive stocks. Do you see the difference? Survival first, lifestyle second. That distinction alone would save a lot of retirees from avoidable mistakes, because too many people still build a single pot and expect it to do every job at once. They want safety, growth, income, inflation, protection, excitement, and liquidity, all in the same few positions. That is not portfolio construction. That is wishful compression. Different needs deserve different tools. That is what serious capital allocation looks like. Now let me bring in another crucial mechanism. I call it the liquidity cushion. This one is not glamorous, but I do not care. The liquidity cushion is the cash or near cash reserve that keeps a retiree from being forced to liquidate longer. Term assets during temporary stress. I like 6 to 12 months of real spending needs in highly liquid instruments. High yield savings if appropriate. Treasury bills, very short-term cash like reserves. Why? Because life does not ask whether the market is down before it presents a roof problem, a medical bill, a family emergency, or an unexpected need. If you have no liquidity cushion, everything becomes a market event. That is a terrible way to live. A proper cushion does two things. It buys time and it buys psychological calm. Both matter. It is much easier to hold good assets through volatility if you know this month's expenses are not dependent on selling into the storm. That is one of the most underrated forms of portfolio safety there is. Now let us talk about the mistakes I see over and over. Mistake 1 is reaching for yield. We covered that. Mistake 2 is market timing. This fantasy never dies. People think they will dance out before the drop and dance back in before the recovery. Most people do not dance. They stumble, they sell too low, they buy too high, they confuse relief with safety and anxiety with danger. That is not a reliable method, especially not for retirees. Mistake 3 is overconfidence. A person may be brilliant in business, medicine, law, or engineering and still be a poor portfolio manager. Those are different skills. Markets punish arrogance softly at first and brutally later. Mistake 4 is false diversification. Owning many positions that all respond badly to the same environment is not diversification. It is a cluttered concentration. Mistake 5 is tax blindness. Retirement strategy is not only asset selection, it is placement sequence, withdrawal planning, tax interaction. Ignoring taxes is a silent leak, just like inflation is. Now let me make the identity flip explicit. Once you are over 60, your job is not to prove how fearless you are. Your job is to become boring in the right places. That is the flip. Not boring because you gave up boring, because you understand what the money is for. The money is not there to impress strangers. It is there to fund freedom, sleep, healthcare, choice, dignity, family. That is why I do not sneer at boring. Boring done properly is one of the highest forms of financial intelligence in later life. You do not need your portfolio to entertain you. You need it to survive you. That is different. Now let me tell you how I would think about allocation in broad terms. A meaningful core in tips and short-duration government. Linked safety, a serious allocation to high-grade corporate bond income from issuers that can survive real stress. A measured allocation to dividend, paying defensive businesses for income growth and inflation resilience. A liquidity cushion, a sensible withdrawal rate, maybe 3% to 3.5% as a realistic starting framework rather than fantasy withdrawal promises built for another era. Does that sound thrilling number? That is why it works. Now I want to close with something hard. A lot of people over 60 are not really looking for safe investments. They are looking for a way to keep feeling young in the portfolio. That is the danger. They do not want to accept that the rules changed. They want one more cycle of aggressive upside, one more run, one more hot idea, one more excuse to ignore sequence risk, inflation risk, income fragility, and the fact that time no longer fixes everything the way it once did. That is understandable. It is also dangerous, because the market does not care how you feel about aging, it only cares about math. And the math says this: when you are living off capital rather than building it, preservation is not cowardice, it is competence. Now let me put the blade into this as cleanly as I can. There are no perfectly safe investments, but there are investments that are honest about what stage of life you are in and what threats matter most. TIPS are honest about inflation. High-grade corporate bonds are honest about the need for income without reaching into trash. Dividend-paying defensive businesses are honest about the need for income growth and durability. Those three categories are not flashy. That is exactly why I trust them more than the fashionable alternatives. At this stage of life, I would rather have an honest, boring portfolio than an exciting, dishonest one. Because honest, boring portfolios tend to keep people housed, fed, independent, and calm. Dishonest, exciting portfolios tend to keep people up at night until they finally pay for the excitement with money they can no longer easily replace. That is a terrible trade. So if you are over 60, stop asking what could make you rich quickly. Start asking what can preserve your capital, pay you reliably, and protect your purchasing power while still giving you enough exposure to keep living. Not just surviving. That is the right question now. And the sooner you start acting like that is true, the safer your money actually becomes.